Okay, so this is Business 436. This is a handout from topic 18, term sheets and investment terms. So I'm going to go over this. I don't know all of this stuff by any means, but we'll just go through this and hopefully you took some notes on this too. Term sheets and investment terms, aligning divergent interests. Okay, so basically you've got the venture capitalist and the entrepreneur, right? So they have different interests. Sometimes they have common interests for the company to do well, but they also have different interests, right? He's investing money to make a lot of money, so he's got to protect his investment. And he's started up a company and he needs money, so two different interests involved. They do have a common interest for the business to do well, though. So you just need to know these concepts, I'm sure. What each side tries to achieve, the investor wants to, this is the investor, like the VC or the angel investor or friends, family, and founders. Maximize their upside, obviously, the investor. Protect investment if company does poorly. He's got this thing right in the way, but it says if company does poorly. Retain control over actions that could affect the investor. So he wants you to retain control over anything that could affect his investors' position. Forced liquidity after a certain period of time. Remember, they want to exit at some point. They want to get their money out. They're not in there for 20 or 30 years investment. I forget what your professor said, how many years these guys usually want to get out in, like 3 or 4 years, I think, but I'm not sure of that. And lock founders and key people into the company in aligned interests. Of course, they want the founders to stay because these are the guys that have the drive and the ambition to make the company succeed. So they want to make sure that they stay in the company at least to a certain point. What each side tries to achieve, well, the entrepreneurs, on the other hand, that was investors, want to get sufficient capital for business. That's the only thing they want to go to the VCs for. They could care less about most of the other stuff unless they can help strategically with customers or management or something like that. Give up as few levers of control as possible, where the VC wants to gain as much control as possible. Protect personal position if they become surplus. And basically, if sometimes they want to replace the CEO, who's usually the founder, he wants to protect his position, but that's negotiable at some point. And have a fair chance of reward, which is an upside, right? How is this accomplished? Well, there's the term sheet, which is a separate video and a separate handout. Investment documents, I'm not sure what they mean there, but maybe they went over that with you in class. And then preferred stock with, this is from the VC standpoint, the preferred stock with higher returns over common, more control, and the conversion, which we talked about, liquidation preferences and the preferred preferences. They get some type of preferred participating preferences at conversion, liquidation. How VCs manage returns. That was just you texting me, actually. Liquidation preference protects in lower exit. They pay too much for their stock versus the conversion. So remember, liquidation preferences, we went over that in the video where they get so much, 1 time or 2 times, usually 1 time their investment back, and then they participate as far as equity also. Keeps from too early of a sellout. And this is with liquidation preference, not applied in IPO. Remember, liquidation has to do with the sale or bankruptcy type of situation. Sale of the company where you're selling out completely, they're buying all of some other company's buying you out, or the bankruptcy, you're just liquidating. It is not an IPO. An IPO is just a financing event where you're going public. And it can be multiples of the investment also. Participating preferred stocks as a special example, and we've got problems and videos on this, so take a look at that. Okay, so that's how they manage their returns, with liquidation preferences in case the company liquidates, and participating preferred stock. Okay, how VCs manage returns. Milestone investments, where they give tranches of investments, like 100 million now, a million 6 months from now, another million a year and a half from now. Options, they can, and this is all be in the term sheet, options to invest more, preferred dividends, which is dividends on your preferred stock, and this would all be in the term sheets. Anti-dilution provisions, where you can't dilute the company, or it basically spells out how the company can be diluted or if it can be. Pay to play versus other investors, I'm not exactly sure what that means. And washout rounds, example being pre-money at $1,000, and I'm not sure what that means also, so you may want to look back at your notes that when he presented this in class. How VCs manage controls, veto rights on restricted transactions such as issuing more. So again, in the term sheets, it would say, okay, we have vetoes right over you issuing more stock, transferring stock, borrowing money, selling, merging, or liquidating. And they could have so many members on the board, so the structure of the board, makeup and appointment rights, voting rights, with stock or board members, redemption rights, forced sale clauses. These would all be things that are within the term sheets, and it's how VCs manage to control some things in the company. Registration rights, not really sure what that means. Tap along and drag along rights, never heard of that. But again, hopefully you took notes on these. And I think it's more important that he might ask you one or two questions on some of these, but he might ask you questions also, what different things do VCs use to control companies that they've invested in? Information rights, preemption rights. So hopefully you took some notes on those. How VCs and entrepreneurs align. Okay, so the founders have stock, so obviously, it's important for them, the stock to do well. They might get options to buy more stocks. They're vesting. They invest over time. Pricing of the options. So vesting means, the period of time that you can exercise an option, basically the pricing that you can exercise it. Accelerating it, I'm not exactly sure what that means. Non-compete agreements is basically you make it so that if, say for instance, they replace the founder with the CEO, but they have a non-compete clause where he can't do anything in the same line of business for 2 years, 5 years, whatever. Intellectual property assignment, I don't think I have to go over anything with you because you've got that other IT 428 class. You probably know more about that by far than I do now. Special case convertible debt, and that's one of the videos that I did a video on. Other risks, investor misalignment, I'm not sure what that means. Investor fatigue, like they want to get their money out, I'm sure. And board conflicts between board members that represent investors and board members that represent the founders. Okay, so that is the handout. Hopefully you've got some notes on this, because some of those things I'm not familiar with for term sheets and investment terms from topic 18.